People have only been with us recently. Some people might be coming here for the very first time ever. What exactly, not what it does, but what is flat earth trading?
Well, in August 1st of 2023, I started the Flat Earth Trading Society YouTube channel. Now, the reason I decided to call it Flat Earth Trading Society because I wanted to expose the conspiracy of trading. And what that conspiracy is that everything you read about is all about the entry. Any book you pick up, any website you go to, everyone's always talking about getting in at the right time, getting in at the right time, getting in at the right time. And I wanted to point out that the biggest conspiracy of trading is that the exit is more important. The exit is more important than the entry, but yet everyone puts all of the emphasis on the entry. Patrick, one of the things we've been doing in this Trading Psychology podcast is talk about all of the problems that come into your trading after the entry. Very few of the problems happen before the entry. They all happen during the trade or because of what happened in the last 5 trades. So this experiment was to do exactly this. We decided we were going to do 100 trades and we were going to do them randomly on our YouTube channel and to show that we could make a profit choosing random stocks, random currencies, random metals, whatever it is we traded using position management.
Yeah, I've been telling people this for years, but nobody ever wants to hear it. The videos that always rank the highest on YouTube when it comes to any kind of trading is technical analysis and getting in at the most optimal time. And I told everybody, that is not when you make your money. You make literally all of your money on the exit. Yet this is the part that nobody ever pays attention to. So you spoke about randomness, and I think that's kind of where the whole idea of flat earth trading comes in. So can you talk about the method you actually used to pick some of these positions?
We did 100 trades. I know some of the notable ones that I liked was a Ouija board. I used a Ouija board, I think 3 times. So I had to go first invest in a Ouija board. I don't think anyone's ever used that term, invest in a Ouija board, but that's what I did. I use Scrabble tiles. I love to travel, so I do a lot of traveling. So a lot of the trades were based on my travels. I was over in Europe, and so we used European stocks. We use train stocks when I take trains places. Just lots of things that going on either in my life or on Fridays, we always did like a trade on the news. We would pick something that was in the news that week and make a trade based on that. And we usually used a lot of like a random wheel. We used quite a bit online where we had 10 stocks and we just spun a wheel and whatever one it landed on, that was the trade we made.
So completely random. No rhyme or reason why you even chose the instrument you chose. So that was something too. Okay, cool. So now I would imagine that with just any basic, sensible position sizing and exit strategy, that this should go fairly well if you just stick with it. So before we get to that, can you just tell people who are playing at home here what exactly the exit strategy was and the position sizing and everything like that, just so everybody can kind of be up to speed here?
The exit strategy was very simple and it was completely automated. We were going to do a 1% risk on the trade, meaning we would do our position sizing. Based on if we were stopped out, we would experience a 1% loss in the account. Then we simply put in a trailing stop on the entry, and that trailing stop was in place the entire time. So if the stock ever went against us, more than 2x ATR, it got us out. That was just the basic rule of the trailing stop. And then if we got a profit, we would snug up that trailing stop a little bit over time. But really, the whole idea of this was you're going to get over 100 trades, no matter how hard you try, you will get a bell curve distribution of results. No matter how good you are at charting, no matter how good you are at calling the markets, you're going to have the tails. You're going to have 4 or 5 amazing trades out of 100, and you're going to have 4 or 5 complete garbage disaster trades. No matter how good you are, no matter how hard you try, you will have 4 or 5 garbage trades. The whole premise of this experience was, hey, how about we chop off all the garbage trades at a 2x ATR loss, but yet let's leave all the great trades to go 5x, 6x, 8x ATR to where we can get an asymmetric return. And that's why I was so convinced that this was going to happen, because I knew that when you get that bell curve distribution, if you just chop off that really nasty left side of bad losses, the numbers will work out for you in the end.
So I'm sure there's a lot of people who have been listening to us the whole time, especially newer traders who are like, okay, this all sounds great in theory, makes total sense, but does it actually work in practice? And so this is exactly what Flat Earth Trading was trying to accomplish. Now you have just approached your 100th trade. You now have a full 100 trade sample size, which I feel is probably enough to get a pretty reasonable idea of if this very simple yet disciplined theory works. So go ahead. Let us know, Rob, what were the actual results after 100 random ass trades with nothing more than a basic, simple position sizing and money management strategy that you just simply stuck to?
Let's just start off with the one everyone wants to focus on. What was the return? Well, we started with the $100,000 account, and at the end of that 1 year period, that account was at $114,674. Now that is after fees. When you just take a look at the trades themselves, the account was up $15,000.26. So that was a 15% return. And during that period of time, we never really had more than 20 to 30% of the account invested at any one time. So there was a lot of cash left sitting there that could have been doing a lot more. But look, that wasn't the purpose of this experiment. And actually on about trade 95, I got a comment saying, hey, you're up nicely, but you didn't beat the S&P. This trading strategy is garbage. And I responded, okay, you obviously don't understand the purpose of this. The purpose of this is not to actually use this system to trade, because guess what? This system is not the best system that you can design or that I can design. It's a very simple system made for this experiment. There are much better ways to design this system, so no one should trade it. The purpose of this whole thing was just to show you consistency, and following a position management strategy that makes sense will yield positive results.
And let me go ahead and add, too, a couple things that are fairly obvious. One, almost every other year, this strategy does beat the S&P 500. And this, when you do things like this and you get to trade long and short, then this is pretty much how it's going to be almost every time. Two, this is a very, very conservative position sizing. I get made fun of for being too conservative when I tell people to go 2%. You went 1%. So you can almost reasonably assume that if you went 2, this would be almost doubled, minus fees and drawdown and things like that. So everybody just kind of keep that in mind as Rob moves forward.
Let's keep going with the numbers. So the win-loss percentage ended up being exactly 40%. So we had 40 winners out of 100. So that was the win-loss percentage. Now look, I already knew that it was going to be around 40%. And if you go back to the very, very first video I did, I said that we are setting this system up knowing that when you put a stop in at 2x ATR, you have an X percentage chance of being stopped out, and it was right around 33, 34%. I already knew that, look, we were going to have, 34, 40% of winners, but then we were going to have a whole bunch of stuff in the middle that went up a little bit and then pulled back 2x ATR. In my mind, I thought, hey, we're going to be around 40%. For most of the experiment, we were actually down around the 33, 34% range. And I was like, hey, this is a little bit lower than I thought. But by the end of the experiment, we were right up to the 40% win-loss.
Well, I have to jump in here. If you're pretty much coin flipping this entire time, how did you expect to end up at 40% and not 50%?
If it was a true coin flip, we would be using basically a stop and a limit order. The fact that we didn't have a limit order up at 2x ATR, so if you put in a stop at 2x ATR and then a limit at 2x ATR, you would have expectations of 50%. That's just what you should have. The fact that we had a trailing stop, so just think if a stock went up $1 and then pulled back, then all of a sudden that's going to be a loss. So we knew that 33% of the trades were going to hit that initial 2x ATR loss. We knew that. What we didn't know is how many were just going to be oscillating in the middle, where they went up $600 and then they pulled back and created a $400 loss. That was where we didn't know. We knew that we were going to have, 32% that went up above 2x ATR and kept going. What we didn't know is how many in the middle would, go up a little bit and then pull back and knock it out. So I just estimated.
Okay, fair enough. And there will be a more detailed analysis of this. We'll talk about that more towards the end, but we're just going to stick to the main stats right now. I just want everybody to understand the results you're about to hear, start to back, or all the other results you're about to hear, came from a system that only won 40% of the time and had, I'm going to say it again, had a 1% position sizing instead of a 2. So just factor all that in as you're listening to this, and just think what actually could be if you were to get those numbers up a little higher on the percentage side.
And remember, this is doing dumb stuff like Ouija boards, Scrabble tiles, coin flips. Like, you can do better than a Ouija board. At least I hope you can. Let's follow up with the numbers here. If you go back to my very first video, I said, we are not going to win this by win-loss. We're going to win this by profit factor, meaning I know that out of 100 trades, I'm going to get 3 or 4 really big winners. I know that. And if I can cut out the 3 or 4 really bad losers, I already know I'm going to have a profit. So the profit factor was 1.38. So basically, if you total up all the gains and then divide it by all the losses, that's profit factor. The average risk reward, winners were 1.9 to 1. So 40 of the trades won $1.9 for every dollar that the 60% lost. That is how it made money. The average winner was $1,351. The average loser was $662. That's right there. That's how you win this game, is right there. Think about it. Your average winner, $1,300. The average loser, $600. You don't need to be much more than 40% to have a really nice return. If you can bump that up to a 50% just on some basic learning how to read a chart and having better entry points, better than a Ouija board, that's a really good trading strategy.
Yeah, I mean, it's really simple, guys. It goes back to the very basics. Cut your losses and let your winners run. Don't cap your upside. And if you just do simple things like that, this is what comes out of it, even with a 40% win rate. So, okay, so we have a lot more numbers here to go over, Rob. And what's really interesting about this is every set of numbers really corresponds to an episode we've done here on the podcast. So, Rob, I'll let you put the numbers out and give a little explanation on them, and I'll jump in and say kind of where this correlates to which episode we've already shot.
When we were talking earlier, that's exactly what we said, is that so this is a real world trading experience with real capital in a real market. And we've always said you have no control over the return. All you have control over is your system and not screwing it up. And so throughout the year, we had runs, we had falls, we had drawdowns, we had wild successes. We had all those things. And in every single one of those situations, we've talked about that in one of the episodes where a real live trader in that real life situation would have a psychological struggle come into their trading that would try to get them to deviate from following their system. Now, we've talked about how you have no control over the market. During this period of time, the S&P had a pretty good return. So it was from August 1st, 2023, all the way to, I think our last trade closed out on like July 15th, maybe July 20th, somewhere around there. So almost a full year. I don't have the return of the S&P during that time. I think it's probably close to about 22, 23%, but I don't have that number. I'll get that number later. But during that period of time, if you were to break out all the longs versus the shorts, the longs were profitable almost $19,000, $18,919 The longs were profitable, and all of our short trades were actually a drag. They were down $3,919. So we were making short trades during that time. And the whole time, the market was mostly going up. Those are going to be a drag. Now, of course, you look at those numbers and say, well, why don't you just go long all the time? Well, guess what? In a market like 2022, it probably would have been the exact opposite. This is where being a trader, you need to be market agnostic. Whether it's up, down, or sideways, your strategy should work in all market conditions.
And I guess this kind of goes into the episode we talked about when it comes to biases, how everybody has an idea in their head already whether a particular currency pair or a particular stock or indice or crypto pair should be going up or down, and how that might actually throw a wrench into our plans when our actual system is telling us to go the opposite way. And so I guess the real takeaway here is to do what we said in that episode and just completely ignore it. Everybody has biases. It doesn't mean you're right. Your system has been proven to be right through backtesting. You have not. So always default to your system in these particular situations.
The beautiful thing is that with a good system should be putting way more long trades on in a bullish market than short trades. That's how a system should be designed. And it should be putting on more short positions in a down market than an up market. I mean, that's just how a system should work. All right, now next I want to jump into some of kind of the highlights, some of the big highlights, some of the big wild successes, and some of the spectacular failures. So I want to first talk about the largest win of the experiment. The largest win was a stock PIO. Now, I put this trade on when I was traveling in New Zealand. And for any of you who have ever been to New Zealand, it is an absolutely stunning country. It is outdoor paradise. There are waterfalls and water everywhere. I mean, every single turn is the most amazing thing you've ever seen. And so I was so impressed with the water, I said, hey, let's do a trade on water. And I looked up that there's some water ETFs, stocks that own other water companies. And we ended up buying this PIO, and it ended up going up, 6.6 ATR is the biggest gain we had. So we had 6.6 plus ATR on this one. It was the biggest gain. Now, what did we learn from this gain? Now, look, we knew we were going to get one of these big ones. What did we learn? Well, I did this because, I was on vacation. I hadn't put out a trade in like a week or two. I'm like, hey, I need to make a trade. I made a quick trade on this PIO. And then you know what? I went back to vacation. I gave this trade zero thoughts whatsoever. It ended up being the best one.
Well, it seems like you did give it a little bit of thought because the theme was water. I don't know. I guess it's still pretty random. But I'm just trying to think of what like a total hater who came into your YouTube channel would say, because haters will find any little wrinkle, any little angle they possibly can to try and discredit your theory.
But look, I could have been short. I could have been short PIO. I could have been long PIO. Like, it could have been anything. But the point for this trade is, just think about how in trading, how hard we all try to make great trades. We try so hard, and we spend so much mental energy, and we spend so much stress and put so much pressure on ourselves, when really, you have no control. You have no idea which one of the trades that you make are going to be good and which ones are going to be bad. You have no idea. One of the very first things we have people at Maverick do is go through my talk. I call it the 10 trade analogy, where in the next 10 trades you make, you're going to put a lot of effort into these. You're going to read charts. You're going to draw lines. You're going to run Fibonacci extensions. You're going to do all these things that you've spent just so many hours of your life focusing on. In the end of those 10, you're going to have probably 5 winners, 5 losers. And out of those 10, you're going to have 1 great one, 2 okay ones, 3 that are and then the rest are going to be small losses, and there's going to be 1 or 2 that are just the worst trades you've ever made. Here's the irony. You think that every single one of those trades you're making